Inflation came in high, but tolerable. That's good news for markets, but with jobless claims spiking, is the tariff soft landing really safe? So, core CPI rose 0.3% month over month, much hotter than the Fed's 2% annual target, but still seen as okay given the tariffs impact. Meanwhile, the overall CPI was a bit hotter at 0.4%. That was mostly driven by food, which is less likely about tariffs and more about labor disruptions from immigration policy. But the real shocker, weekly jobless claims jumped to 263,000, a 4 year high. Well, just 1 week of data, it's a big flashing red light for job market stress. So, what does this mean for rate cuts? Well, that 25 basis point cut next week looks locked in, but investor focus is already shifting to what's next. Markets are pricing in 3 cuts by year end and 6 total through 2026. While Powell sounded dovish at Jackson Hole, we still want to see how much the Fed has actually shifted. The last dot plot back in June had only penciled in 4 cuts through next year. While the job market seems very fragile, if the Fed cuts too quickly, it could risk reigniting inflation that's still sticky with tariff headwinds still to come. So the stage is set for next week's Fed meeting. The big question, should the Fed move quickly to stabilize the job market, or stay more cautious with inflation still an unknown? What do you think? Let us know.